Let me be blunt with you right now, and I want you to hear every single word I'm about to say, because this is not a drill, and this is not one of those videos designed to get you excited about buying some miracle stock. SpaceX is about to go public, and when it does, it is going to trigger the single largest financial windfall this market has ever seen in its entire history. We are talking about $350 billion being sucked out of the exact stocks that are holding your retirement together right now, your 401 kilobits, your Roth IRA, your S&P 500 index fund that your financial advisor told you was safe. All of it is sitting directly in the blast radius of what is coming. The music is about to stop. The chairs are being removed one by one, and most of the people watching this video right now are standing in the middle of the floor without a clue. That ends today. Now, before we go any further, if you are not subscribed to this channel, you need to fix that right now. The analysis I am about to give you is the kind of thing that institutional investors pay consultants tens of thousands of dollars a year to receive, and you are getting it here completely free. The only thing I ask in return is that you hit that subscribe button and the notification bell so that when the next warning comes, and there will be a next warning, you are not the last one to know. Subscribe now, and let's get into it. Let me give you the number that should be keeping you up at night, and then I'm going to explain exactly what it means for the money you have worked your entire life to accumulate. The number is $350 billion. That is the amount of fresh capital that Wall Street needs to absorb in the next few weeks and months, and it does not exist in some vault somewhere waiting to be deployed. That money has to come from somewhere, and that somewhere is the stock market, specifically the biggest, most liquid, most widely held stocks in the market, which happen to be the exact same stocks that are responsible for nearly all of your gains this year. We are not talking about some obscure corner of the market that most people have never heard of. We are talking about the 10 companies sitting at the top of the S&P 500, the companies that account for 72% of every single dollar gains the index has produced in 2025, 72%. So when someone tells you they are diversified because they own the S&P 500, what they are actually saying, whether they realize it or not, is that 72 cents of every dollar they made this year came from just 10 companies. That is not diversification. That is a concentrated bet wearing a diversification costume. Now, I want you to understand something about how markets actually work when a massive event like this hits, because most retail investors have never lived through a structural liquidity drain at this scale. When large institutional fund managers, the people who manage pension funds, endowments, mutual funds need to raise hundreds of billions of dollars in cash quickly, they do not sell the stocks that nobody wants. Those stocks do not have enough buyers to absorb the selling without collapsing instantly. What they do instead is sell what they can sell, which means they sell the most liquid, most widely held names in the market. They sell Microsoft, they sell Nvidia, they sell Apple, Amazon, and Alphabet. They sell the names that every retail investor in America owns, because those are the names where there is always a buyer on the other side of the trade. So the coming IPO wave does not just affect the new companies coming to market, it reaches back through the entire ecosystem and hits the stocks you already own. This is the mechanism that most financial commentators are simply not explaining to their audiences. And it is the reason this moment is so dangerous for the average investor who is sitting comfortably in their index fund thinking they are protected. The debt markets have already started choking. In the first 5 months of this year alone, AI-related companies issued $110 billion in debt. Borrowing costs have risen. The lenders who normally absorb tech debt are tapping out, which means these companies are turning to the only other source of capital available to them, the stock market. They are printing shares. Your shares get diluted, and $350 billion gets pulled from a pool of capital that was previously holding your portfolio up. This is not a theory. This is arithmetic. And arithmetic does not care about your feelings or your retirement timeline. Now let me walk you through each piece of this $350 billion number, because I want you to understand precisely where it is coming from and why it is arriving all at the same time. Because the simultaneity of this is what makes it so dangerous. Under normal circumstances, the market absorbs large capital events gradually, spread out over months or years, and the system adjusts without too much disruption. What is happening right now is not normal. 3 of the largest private companies on Earth are racing toward the public markets at the same time, and the combined capital requirement is something this market has never seen before. Start with SpaceX. We are talking about the largest IPO in the history of global capital markets, not American capital markets, global capital markets. SpaceX is targeting approximately $75 billion in the offering. To put that number in context, the previous record for the largest IPO ever was Saudi Aramco in 2019, which raised approximately $29 billion. SpaceX is asking for more than 2.5 times that amount. This is not an incremental event. This is a seismic event. And $75 billion does not appear out of thin air. It comes from fund managers liquidating positions in existing public companies to free up the capital needed to participate in the offering. Every dollar that flows into SpaceX is a dollar that flows out of something else. And that something else is almost certainly sitting in your portfolio right now. Then you have OpenAI, the company behind ChatGPT, which has also filed its paperwork and is targeting approximately $60 billion. Think about what that number means in practical terms. $60 billion in new capital demand, competing for the same pool of institutional money that is already being stretched by SpaceX. And then right behind OpenAI is Anthropic, the maker of Claude, targeting another $60 billion. Add those three numbers up, minus $75 billion, $60 billion, $60 billion, and you have $195 billion in IPO capital demand arriving in essentially the same window of time. And not one of these companies is some scrappy startup with unproven technology. These are companies with genuine businesses, genuine revenue, and genuine institutional interest, which means the demand to participate in these offerings is real, and the selling pressure required to generate that participation capital is equally real. The reason all three are hitting at the same time is not a coincidence. It is a function of the same underlying dynamic. The debt markets have become inhospitable for AI-scale capital raises. Interest rates have made borrowing expensive. The syndicated loan market is saturated with tech debt. Private equity has already deployed enormous amounts of capital into these companies through private funding rounds, and the next logical step in the capital cycle for the companies, for the early investors who want liquidity, and for the funds that back them, is the public markets. So they're all arriving together like three freight trains converging on the same intersection. And the retail investor sitting in their index fund is standing on the tracks. The IPO wave by itself would be significant enough to warrant serious attention and serious preparation, but there is a second force running parallel to it that makes the total picture substantially worse. And this is the force that almost nobody in financial media is explaining clearly, because it requires understanding a concept. Dilution that sounds technical, but is actually very simple once you see it correctly. Alphabet, the parent company of Google, has announced it is selling $85 billion in brand new shares. I want you to sit with that number for a moment. $85 billion in new shares, freshly created, printed into existence, the largest single stock offering by any technology company in history. When a company issues new shares, it is not giving you more value, it is dividing the same value into more pieces. Imagine you own 10% of a pie. The pie is worth $100. Your piece is worth $10. Now the company prints enough new shares to make the pie into 20 pieces instead of 10, but the pie is still worth $100. Your piece is now worth $5. You did not make a decision. You did not vote on it. It just happened, and your ownership stake quietly shrank while you were not looking. That is dilution, and it is one of the most quietly destructive forces in investing because it does not show up as a loss on your brokerage statement the way a price drop does. It just silently erodes the value of what you own. And Alphabet is not alone. Meta, which owns Facebook and Instagram, is reportedly preparing its own massive share offering, and the market's reaction was immediate and instructive. Meta's stock dropped between 5 and 9% in a single day on the rumor alone, not the announcement. The rumor that tells you everything you need to know about how the market is pricing dilution risk right now. And Microsoft is spending nearly $200 billion on AI infrastructure this year. Amazon is running a parallel build-out. The pressure to fund AI at this scale through equity rather than debt is systemic across the entire sector, which means this is not a one-time event. It is a wave, and the wave is still building. So while $195 billion is being pulled out of the market to fund the three IPOs, an additional $150 billion or more is simultaneously being created in the form of new shares that need buyers. And all of that selling pressure lands on the same pool of existing capital that is already under pressure. The $350 billion number is not a worst-case scenario. It is a conservative baseline. Now I want to bring these forces together into a single coherent picture, because understanding each piece individually is useful, but understanding how they interact with each other is what separates the investors who come out of this period. Wealthier from the investors who come out of it, poorer. There are three distinct forces converging on your portfolio simultaneously, and each one is independently significant. Together, they create a structural pressure event that has no modern precedent at this scale The first force is institutional selling to fund IPO participation. Large fund managers who want to allocate capital to SpaceX, OpenAI, and Anthropic need cash. They generate cash by selling existing holdings. The holdings they sell first are the most liquid names, the top 10 stocks in the S&P 500. The same stocks that produce 72% of your gains this year. This selling is not driven by any negative view of those companies. It is purely mechanical. The fund needs cash. The cash comes from selling liquid assets, and the most liquid assets in any institutional portfolio are the mega-cap tech names. You do not need to be Peter Lynch to see where that pressure goes. The second force is dilution from share issuance by the companies themselves. As I just explained, Alphabet is printing $85 billion in new shares. Meta is preparing to do the same. Microsoft, Amazon, and others will likely follow. This is not speculative. This is the rational response of large companies that need enormous amounts of capital quickly in an environment where debt financing has become expensive and constrained. Each new share that is issued dilutes the value of every existing share, including the shares sitting in your 401 kilobits and your index fund. You do not get a vote. You do not get a notification. It simply happens. And your ownership stake quietly becomes smaller. The third force is the one that is perhaps most insidious because it is completely automatic and completely invisible to most retail investors, and it is called index rebalancing. Under the Nasdaq's fast entry rule, when a company like SpaceX goes public and is large enough to qualify for inclusion in the Nasdaq 100, it can be added to the index within just 15 trading days. And when it is added, every single Nasdaq 100 index fund in the world is automatically forced to buy SpaceX shares to maintain its proper weighting. But these funds do not hold cash reserves to buy new additions. They have to sell existing holdings to generate the capital to buy the new entrant. So your index fund sells some of your Microsoft, some of your NVIDIA, some of your Apple automatically, mechanically, without asking your permission to make room for SpaceX. And then a few months later, when OpenAI joins the index, the same thing happens again. Then when Anthropic joins, it happens a third time. 3 separate rounds of forced selling, all targeting the same pool of mega-cap tech stocks, so all compressing into the same relatively short time window. And if you hold a target date retirement fund through your 401 kilobits, you are exposed to this exact same mechanic, whether you know it or not. These 3 forces are not independent of each other. They are mutually reinforcing. Institutional selling to fund IPOs reduces the price of mega-cap stocks. Lower prices mean the index funds need to sell even more shares to raise the same dollar amount of capital for rebalancing. More shares sold means more downward price pressure, which means more dilution impact per share from the secondary offerings, which creates further selling pressure from funds trying to manage their weightings. This is a feedback loop, and feedback loops in financial markets have a way of moving faster and going further than anyone initially expects. The investors who understand this dynamic before it fully develops are the ones who will be positioned to take advantage of it. The investors who discover it after the fact are the ones who will spend the next several years waiting to get back to even. Everything I've told you up to this point is the diagnosis. Now I am going to give you the prescription. And I want to be very clear that I am not a registered financial advisor, and nothing I am saying here is personalized. Financial advice. What I'm giving you is a 3-step analytical framework, the same kind of framework that institutional investors use to navigate structural market events. And I'm giving it to you in plain language so you can apply it to your own situation today before the pressure fully arrives. Step 1 is to calculate your actual concentration right now, today, before this video is even over. Pull up your brokerage account or your 401 kilobits portal and identify every position you hold in S&P 500 index funds or Nasdaq index funds. Take the total dollar value of those positions and multiply it by 0.40. That number is your real exposure to the top 10 stocks. It is the amount of money you have effectively concentrated into a single basket. Regardless of how many funds or accounts it is spread across, if you have $200,000 in index funds, you have $80,000 sitting in 10 companies. If you also separately own shares of Apple, NVIDIA, or Microsoft because you wanted additional exposure, add those to the total. Most people who go through this exercise discover that their portfolio is dramatically more concentrated than they believed it was, because the index fund creates an illusion of diversification that the underlying concentration data completely contradicts. You cannot make intelligent decisions about risk if you do not know your actual risk. Calculate the number, write it down, look at it honestly. Step 2 is to understand where institutional capital is rotating when it leaves mega-cap tech because the money does not disappear, it goes somewhere. And the investors who identify where it is going before the rotation is complete are the investors who capture the gains on the other side of this event. Right now, if you follow institutional money flows carefully, you will see movement into energy, both traditional energy, infrastructure, and the emerging energy demands of AI data centers, which require enormous amounts of power. You will see movement into defense and aerospace, into basic materials, into select areas of healthcare and biotech, where valuations are reasonable relative to pipeline value. These sectors have not participated proportionally in the AI-driven bull market, which means they have not been bid up to the valuations that make the mega-cap tech stocks so vulnerable. Right? Now, money rotating from overvalued assets into reasonably valued assets is the fundamental mechanism of every major market rotation in history, and the setup for that rotation is more clearly visible right now than it has been at any point in the past 5 years. Step 3 is to build your watch list now, before the dip, not during it, and certainly not after it. This is the step that separates disciplined investors from reactive ones. The disciplined investor makes a list of high-quality companies they would be genuinely excited to own at a price that represents real value, not the current inflated price, but the price that would exist after a 20 to 30% correction in the most overvalued parts of the market. They identify that price in advance. They set alerts, and when the market gives them the opportunity, they act according to the plan they made when their thinking was clear, not in the heat of a market downturn when fear is making every decision feel wrong. The worst investors in the world are the ones who know exactly what they should have bought in hindsight. The best investors in the world are the ones who knew what they were going to buy before it went on sale. Make your list today, set your prices, be specific, be disciplined. And when the music stops, you will be one of the few people in the room who already has a chair. The legendary investor Mohnish Pabrai, one of the most successful value investors of his generation, was asked recently about the S&P 500 at current valuations, and his answer was a single word: bearish. The index is trading at a price-to-earnings ratio of approximately 30. The long-term historical average is 16. That means stocks are priced at nearly twice their historical normal valuation, a level of overvaluation that is more extreme than what existed in 2000 immediately before the dot-com crash. Warren Buffett's Berkshire Hathaway has sold its S&P 500 index fund holdings entirely. Tom Lee, the most consistently bullish analyst on Wall Street, the man who correctly called the bull market in 2023, 2024, and 2025, is now warning of a 20% correction driven by Fed uncertainty, AI valuation, repricing, and policy fragmentation from trade conflicts. When the most bullish, credible voice on Wall Street tells you to brace for impact, that is not the time to argue with them. That is the time to have your list ready. Here's where I leave you, and I want these words to land with the weight they deserve. Every great bull market in American history has had a shakeout. Every single one, without exception. The 1990s had one. The 2010s had one. This bull market will have one too. And the evidence that we are approaching it is as clear and well documented as any setup I have seen in decades of studying markets. This is not 2008. The financial system is not collapsing. The economy is not ending. What is happening is a $350 billion game of musical chairs. And most of the people playing it do not know the music is about to stop. The AI revolution is real. Space is real. The technology being built by these companies is genuinely transformative. But transformation takes longer than the market prices. And the stocks pricing in that transformation are doing so at valuations that leave almost no margin for error. The people who get rich from transformative technologies are not the ones who buy the hype at the peak. They are the ones who buy the hangover at the bottom. Your job right now is to calculate your concentration, understand where the rotation is going, build your watch list, set your prices, and be ready to act when the opportunity arrives. Do not panic sell into the decline. Do not try to call the exact bottom. Just be prepared, be specific, and be disciplined. That is the entire framework. Now go execute it.